Good afternoon, folks. David here for this week's weekly analysis session. This Wednesday, 13th of May 2015. Very cold in Melbourne here today. Hopefully you're in a warmer location where you're sitting at the moment. You can sit back, you've got a cup of tea, and enjoy yourself as we go through this week's education session. First cab off the rank is our disclaimer, and I have to go through this just to alert you to the fact that the content of this presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your financial objectives, financial situation, nor particular needs. So before making any investment decision based upon the content covered in any of the ETC presentations, please consult your licensed advisor, whoever he or she may be, before embarking upon any investing decisions. Today's agenda. After last week we obviously talked a little bit about some of the small amendments to the trading methodology, just to try and make your interaction with the markets a little bit simpler. I'm a firm believer that if you have a investing or trading process that is simple and easy to do, then you are much more likely to stick to it. And that's really important for when the going gets tough, as it surely will from time to time, and it's going to test your ability to stick to your trading rules. So certainly my agenda is to help you come to terms with your trading strategy and make it as simple as possible for you to implement. And that way you're much more likely to stick on your journey and come out the other side a much better, a wiser and experienced investor as a result. So last week we talked about trade management topics, in particular managing our trades in such a way that we allow our trades the ability, if you like, to evolve to their fullest potential. And that's going to occur when the market is in agreement with that particular stock and continues bidding the price of it up until eventually it becomes either overvalued or there's some fundamental news that changes the story. And from that point of view, we just want to have some simple rules in place that tell us when to get out, and I think a trailing stop does that very well. It's not a guarantee that all of your trades are going to end up being long runners, but it certainly gives them the chance to do so. So that was discussed last week. This week, really just having a little bit more of a look into our trading plan and thinking about some of those elements which make sense and some which I'll leave you to be the final decider upon. So the topics for this week's discussion centre around round numbers, whether they are important or not, and in light of this I'm really referring to medium to longer term strategies. So whether round numbers, do they have an impact? Is the impact that they have substantial, or is it something that you can choose to use at your own discretion? So we'll talk through that. Certainly long-term peaks, it's all in our trading plans, and I'm a firm believer that we absolutely must steer clear of long-term peaks. Long-term peaks, major points of supply, so we'll be discussing through that. The price volume volatility signal on Beyond Charts. I'd be interested to get some of your feedback on that as to how you're using it. What rules you've been applying to it, and my slant on the ways that I think you can use it to optimize some of your trading outcomes and to put some money in your pocket along the way. The last point on this is really important. That's of price action. We discussed a little bit in the weekly analysis session, elements of price action. In the background here, myself and David Seal have been working hard on a couple of scans and improving the scans so that the output on Beyond Charts, once you've completed your scans, is easier for you to create a shortlist. So far we've managed to get a list of around about 529 results from a US weekly scan down to around 115, and on going through that list of 115, it's certainly picked up the trades that I would have looked at in the longer scan, but certainly taken a far less amount of time. So I think you'll all be able to benefit from that. We're not going to let you have that right at this minute. We just like to test it over the next few days just to make sure that it's good and working appropriately. And as soon as it is, then absolutely we can either send you out the formula in an email, or you can book a coaching call with us and we'll talk you through the process on TeamViewer, how to speed up those scan results, or rather not necessarily speed up the results, but shorten the list, if you like, of the results that you've got to go through. So that particular scan, it was on the topic of price action, and the end result really is with a shortened scan, all you'll need to do is go through and check your price action filter, and that's part of the topic for today. So we've got a fair bit to cover. We've done the disclaimer, so let's hop into it. All right, round numbers. Some stocks do and some stocks don't. It's pretty clear that by now, if you go back over any number of stocks that you're familiar with over the last 5, 10, 15 years, or the last 2 or 3 years that you've even thought about round numbers, is that some stocks do pause momentarily at round numbers and some stocks ignore them completely. I think the concept of round numbers makes sense in a shorter term context, perhaps where you're looking to get in and get out. I think from the longer term perspective though, the jury is really out on their impact on the final outcome of your trade. In the past, we've used round numbers as exit strategy, so if we were coming up to a round number, using the presence of that round number to take some profits, exit the trade completely, depending on whatever the market risk is. And that's fine if you want to continue to do that. I don't have any problems with that. That's part of something. If you find that that's in your process and you like doing it, then that's a good thing, because it means that you're going to stick with it. But if you'd prefer to ignore the round numbers and choose to sit on the sidelines and allow your trades to run their full extent, then I think that opens up the doors to some potentially quite significant profits. I've gone over some of the results, in the previous webinars, examples of the sorts of trades we're talking about. But simply, staying in a trade until eventually you get stopped out and ignoring the round numbers has turned some trades that were potentially already very good trades in their own right, from somewhere in the vicinity of 80 to 100% returns, seeing those returns increase beyond the 200 and 300% just by being patient, ignoring the round numbers, and finally allowing your trade to stop you out with the use of a trailing stop. So as far as Elite Traders Club is concerned, I won't be using round numbers as a key decision maker in the setups that I'll be looking at. Again, the focus is really on looking for those bigger moves, and if we're patient and we have a really simple strategy, then we've got the best chance of getting those sorts of returns. Demand and supply, at the end of the day, is what's going to drive price. Now, if we take a step back and think about what it is that's creating the demand and supply, it's very easy when you're first learning about things to think that you and I as individual traders are creating that demand and supply. And certainly we do make up some of that elements of demand and supply, but largely demand and supply is driven by the bigger players in the market. And the bigger players in the market don't use charts to determine whether they're going to invest in a stock or not. So we're really talking about the big end of town, the financial institutions, the fund managers, etc., who are managing literally billions of dollars on behalf of their clients, have to find a home for it. They're not punters. They're not going to look at a chart and say, well, look, that looks good or that looks bad, or flip a coin. They're going to invest very heavily in their own resources, and that means people like Jeff Saffer, people who are fundamental analysts poring over companies' books, and they will base their decision on whether to purchase a stock or not purely on its value, if you like. And the way they do that is obviously through fundamental analysis. So the big picture that we get to see despite what one fundamental analyst might think of a particular stock, they might think that it's fantastic and therefore recommend to their fund to purchase it, and yet other fund managers operating in exactly the same market may come to a different conclusion. Again, depending on what sort of valuation techniques they might be using or prefer. The end sum of all of this information going on in the market is that we get to see the outcome on a chart. And so we get to see the outcome of that demand and supply as a factor, if you like, of all the fundamental analysis that's been done in the background. And I think from that point of view, and sitting next to a guy who does fundamental analysis just about every day of the week, they certainly don't think about round numbers. They, in their valuations, will come up with generally a price range that a stock's valued between $3.80 and $4.65. What makes them say $4.65 or $3.80? It's basically just what their models suggest. And at the end of the day, they're not really going to be looking at something just because it's $4, $5, $10, $15, $25, etc. So, as far as I'm concerned, from the longer term trades, I'm going to be ignoring the round numbers because I'm looking for those longer rides. But certainly, if you wish to continue using the round numbers, there's absolutely nothing the matter with doing that at the same time. Okay, whatever you find easy to do and repeatable, that's going to be a big key to your investing success. Long-term peaks and long-term troughs. Absolutely, there is no arguments about this. We must give way to long-term peaks and long-term troughs. Just a quick definition of the two here. The highest point between a medium-term uptrend and a medium-term downtrend is what we call a long-term peak. These peaks are significant or major points of supply. And if you think about it, if we have a medium-term uptrend on the way up and a medium-term downtrend on the way down, there is something lurking at the tip of that has turned the entire trend around. Typically, the entity, if you like, that has turned that around is usually a group of funds, as an example, that have found something has changed in perhaps the way that a company or a stock is being performing. It might be a change in management, it might be something fundamental in the background that is going to have a significant impact on the stock's value, and as a result, fund managers are starting to look for opportunities to liquidate, and when they all start liquidating at around about the same time or a period of time, then we can get a significant turnaround in trend. So with that in mind, when we're thinking about these long-term peaks and also long-term troughs, as major points of supply, they tend to act as future points of supply. And I've got a chart in a moment that we'll have a look at to elaborate on this a little bit more. They tend to act as future points of supply until that future point of supply is broken. Once that future point of supply is broken, it then tends to act as an area of support or an area of demand into the future. Likewise, old points of demand, so the old long-term troughs, tend to act as future points of supply when the long-term trough has been broken. So if you can imagine a long-term trend moving down, coming down to a level, meeting a good demand, a good amount of demand, being sufficient enough to turn the long-term trend that was downward completely around and turning it into a long-term uptrend or a medium-term uptrend, and therefore forming a long-term trough. That long-term trough is a significant point of demand, and if that point of demand happens to be broken at some point in the future, if price ever happens to move back up to that previous level, it tends to act as a point of supply. So we might go and have a look at this on a chart just to illustrate the points. I've just got beyond charts here. I've just done a couple of a couple of scans, etc. That's why I was a little bit late this afternoon. I've done some scans on the US market again and on the ASX. But I'll just bring up a stock to illustrate a long-term peak. I think it was CVG, I think it might have been. CVG, CSV. That's the one that I was looking at as an interesting example. So here in the middle of Beyond Charts, and I'll just zoom in a little bit on here, and at the same time, using my favorites tab, I'll just go up to the ETC swing chart. The thing that I like about the swing chart is it just highlights our peaks and troughs for us. So clearly what we can see is a medium-term uptrend on the left-hand side, two fairly level peaks, if you like, along the way, and then a clear reversal in trend where we've got a medium-term downtrend on the right-hand side. Whatever it was up the top here that created this turnaround is significant, because all the money flow into the stock on the way up has all of a sudden stopped in a fairly short period of time and turned around and gone all the way back down. Now this was in the middle of sort of 2010. There wasn't a lot happening in our market at that time. We'd come out of the GFC. The Australian market in particular rallied very, very strongly during that time. And then towards the middle of 2011, we had the Eurozone crisis with Portugal, Ireland, Greece and Spain, all sorts of issues over there. And in between all of that time, we had a stock that was performing very, very strongly, all of a sudden, over a matter of a few months, turning around and going in completely the opposite direction. It occurred at around about $1.40 level, so if I grab my horizontal line there and just run it across the tops, around about $1.40. And this is a level, again, it's a zone of supply. So when you think about your points of demand and points of supply, try not to think of them as being paper thin, because they're not. They're zones of demand and zones of supply. So we've got a level there through which we could obviously see that stock was being sold off very heavily, continued to be sold off, and every time price tried to move back up, it was met with more and more supply. So symptomatic, we've got lower and lower peaks all the way down. So if we know that there is a long-term peak, a significant event in the market that's caused this at around about the $1.40 level, it's likely that at some point in the future that will provide a level of resistance again, that will again, this old point of supply will become a future point of supply. So we'll go into the future and have a bit of a look. And you'll see that as price starts to come back up, that we're entering that old zone of supply, that major point of supply that's having an impact on the stock. So it really just makes sense that if we know that previously there was a ceiling above our heads, let's wait until we're clear of the ceiling before we start to get interested in this particular stock. So let's continue on forward and just see what's happened. And eventually, as the trend continues and demand is rising for this particular stock, each time that we interact with this old zone of supply, we're removing some of that excess supply, and as long as the demand is still in there and we're stripping away supply, then eventually there's the chance that the stock continue onwards and upwards beyond what was an old area of supply or resistance, if you like. Once price is moving through, we're starting to see that it's starting to act as a zone of demand. So absolutely not negotiable. You must give way to long-term peaks and to long-term troughs if you happen to see them as well. So no changes there whatsoever from your previous trading rules. So let's just go back to the slides for a moment. So long-term peaks, long-term troughs, absolutely not negotiable. We must give way. There's the slide there. Exact same stock, exact same moment. You'll see through the 140, 145 level. Right, price volume volatility. I've got a question on this a little bit later on. You might remember from last week I actually asked a couple of survey questions. So this is one that I'll be asking a question about as well. The price volume volatility indicator is a terrific signal, and it's a great signal because it really gives us a bit of a tip off as to the likely behavior of a stock. Now, not always, but it's certainly a flag for us, particularly if we've made some really nice profits in a trade and the signal goes off. So what we'll do is we'll go through a couple of examples just to see the the impact on this particular indicator. So the question is, how does it work? Good question. I'm just going to have a drink. All right, the indicator itself is based on the idea that price has a normal trading range, and that once price becomes extended, and by extended meaning a multiple of its average trading range, that it's likely to revert back to its mean, its average trading range. So the easiest way to think about this is that price is a little bit like a rubber band, and the market has a habit of pushing stock prices a lot further in one direction than probably they should, and that's not just in an upward direction but also in a downward direction. And so what this indicator does is it looks back at price over a period of time and compares how far it's moved beyond its mean, if you like, its average, and compares that with where it currently is. Now, if it's way above its average price movement, its average trading range, then it's starting to think, right, okay, price has moved a significant amount of distance, and at the same time it's looking for the volume, so the number of exchanges, if you like, in this particular stock that we're looking at. So it's putting together the fact that it's traveled a long distance, and now, given the fact that we've traveled that distance, we've got a big increase in volume. Now, volume on its own is fairly useless. What we need to do is we need to look at volume in association with the individual candle. So particularly if we have high volume and we have a bearish candle or an indecisive candle, if you think about what that means, is it means that we have a whole lot of buyers and sellers completely undecided as to which way the stock might go. Now, the stock has moved a significant amount of time, a significant amount of price rather. It might be in a short amount of time, or it might have been an extended run. And at that point in time, the market is, through volume, telling us that there's lots and lots of transactions, and at the end of the day, it's formed a bearish candle. Now, the signal doesn't always go off with a bearish candle, so you'll look at some charts and you might actually see a white candle and you'll think, well, what's the significance of that? There's really those three elements that it's looking at in conjunction, and then on the basis of that deciding whether or not it's going to print one of these green boxes with a cross in it. Now, when you see that signal on a chart, it's telling you that the future direction of the stock is potentially unknown. Okay, a big increase in volume, an indecisive candle. So from that point of view, if you're well up on your trade, and I know the question will come, well, David, what does well up mean? How far up do I need to be to take notice of this particular signal? I'll get to that in a moment. So when this signal goes off, the easiest thing for you to do is say, well, look, how long have I been in this trade for? Am I up? You know, if I'm risking, as an example, 10% on the trade, and most of your stops, when you place your initial stops, on average you're going to find that your stop price is around about 10% away in price terms from your entry. Okay, around about, ballpark sort of figure. So if you find that you're in a trade and you were risking, 10% in terms of price, and you've been in the trade for a while and you're up 30 or 40%, and let's just suggest that that might be in 3 or 4 months, and you saw the signal go off and you're up 30 or 40% in 3 or 4 months, I think it's only fair and reasonable that you might think, well, I've actually made a good bit of money on this. Is there anything the matter with liquidating part of my position? Taking part profits? Maybe selling half? With the view that if the price does all of a sudden turn around because we've got this indecision in the market, I don't want to give too much back. I'm trying to stick to my rules. I'm trying to extract a longer term profit. But along the way, if there's an opportunity for me to put some money in the bank, surely that's fair and reasonable. And I think it is. Okay, so the indication here is to look for a partial exit. Okay, providing you're satisfied that you've made sufficient on the trade. Now that's going to be an individual choice, but I think it makes sense to look back and say, well, look, I've been in this trade for 1 month, 2 months, 3 months, put it into perspective and have a think about what that means. Because remember, you can always get back into the trade when another setup provides, when you see the opportunity for another setup. So should you be taking partial profits and putting some money in the bank, what do you do with the rest of it? Well, you just stick with your same old, pretty boring 3 ATR trailing stop, because we know that's a long way away from the price action, and we know that it's going to give your stock that you've taken a little bit of profit out of the opportunity to go on and hit a home run. I think that's really important, and it's going to make a huge difference for your overall expectancy. Okay, now remember, expectancy is how much on average you can expect to get from each trade every time you step up to the market. Now if you're taking lots of little hits along the way, you're going to need a very high strike rate. And so therefore the aspect of making sure that you've made a reasonable amount of profit on the trade before taking part profits. If you continue to take lots of small profits along the way, you're going to need to maintain a very high strike rate to become profitable. So that's the price volume volatility signal, and you'll see here on a couple of great examples. And if we have a bit of a think about the time frames which this is set up over, stock here, GEM, and it was a gem for lots of people who were able to first of all locate this stock and trade it successfully and very, very patiently using a boring 3-old ATR trailing stop. It enabled us to get into a trade using the tenements of price action, nice strong price action, getting into a trade, being patient with our trailing stop and not getting out until the trade closed below the 3 ATR. Now remember, when the stock eventually does close below the 3 ATR, it's come back 3 ATRs from its high to be stopped out. Do we want to give back 3 ATRs of profit along the way? Well, maybe not. But it's all relevant, isn't it? Because at the end of the day, if we entered in at the beginning of the trade and we went all the way to the end, we made slightly less than getting out at a prior opportunity. There's a price volume volatility signal here. Now, having been in this trade for a significant amount of time, and at that point being up 206%, and the signal went off, big black candle at the end of the week, remember? That's when the signal goes off. It doesn't go off on a Monday morning, it goes off on a Friday at the close. It closes down on its lows. I'm up 206% in the space of, what have we got? December 2012, and we're getting out in around about February of 2014. So over that period of time, some 476 days, so about a year and, about a year and a third, something like that, I've made 206%, the signal's gone off. If I wait to be stopped out, then I'm going to end up making around about 180%. 180% still not bad. Let's just say that along the way, we were getting a little bit nervous. We'd entered the trade. You'll notice that there's a price volume volatility signal that's gone off. We really haven't even had a chance to move our protective stop yet. So in that particular case, I'm just going to completely ignore that signal. All right, I'm using the price volume volatility as an opportunity to take profits. Well, I've only just got in the trade. I've been in it for 1, 2, 3, 4 periods. I've been in it for a month. Remember, your bigger moves are going to take time to unwind. So I'm going to ignore that, and then eventually, over a period of another couple of months, we get another price volume volatility signal. I've been in the trade 147 days. What have I had to do in managing that trade? All I've had to do is wait for my little green trailing stop, the 3 ATR, to move above my initial protective stop. Again, remember, which is just outside of 2 ATRs and below the most recent trough when we've structured the trade. The signal goes off, and at that point on Friday afternoon, the price volume volatility signal goes off. I have a look at how far the stock's moved. The stock's moved 83 cents, and I'm up 55% in the matter of 6 months. Now, I don't know about you, but 55% in 6 months is not a bad return. So I think from that point of view, if you wanted at this particular level to take half your profits off the table, at least you've made 50% or 55% on half your allotted funds in that particular stock. We continue to trail the stop on the remainder, and we look for further trading opportunities. Potentially we've got higher troughs through here and higher peaks. We're resuming the medium-term uptrend nicely. We could take another trade opportunity potentially through these levels as well. So adding back into the position. The volume volatility goes off again. So if at this point we hadn't taken some profits along the way, we get another signal, well, at that point we're up 118%. Is there anything the matter with taking some part profits and continuing to trail along the way? Okay, so I think it makes sense in the midst of these longer term trends that if there is a bit of an opportunity for you to take some profits off the table, I think that makes good sense, keeping in mind that we're really trying to look for the longest run that we can. I think it's a good way to put some hay in the shed. Another example here on MTU, just recently as an example through here, we had obviously higher troughs, nice motive phase. We'd broken out of this sideways movement, really starting to get moving. A breakout trade, and we were only in it for 1, 2, 3 periods, and we had a price volume volatility signal go off. Well, from that initial point, I really haven't had much to do with my trailing stop. I'm going to ignore that. Let the trend evolve. Price moves up, my trailing stop moves up, and at this point, signal goes off. Look at the bearish candle. I've been in it for 119 days. I've made 24%, which is an annual return, or the equivalent of 94%. Not a bad opportunity there if you want to put some money in your pocket. Again, just depending on, whether 24% is significant enough for you. You might say it's not enough. You go along a little bit further on, you get a couple of other signals as well. Over here, the most recent signal, black candle, end of a Friday, a couple of weeks ago, we find out that we're up 36, nearly 37%. Still travelling along at around about the same per annum rate. Certainly nothing the matter when you think about the time frame for this, the first of the year, and the stock has moved pretty much from about those same sort of levels. Anybody who's got a stock that's up 36% over the since the beginning of the year is doing pretty well. Remember that our market at its peak this year was up 10%. So if you've managed to extract some profits from a stock like that, I think you've done well. And worst case scenario is now that price comes down, closes below your trailing 3 ATR and somewhere just below the $9.92 level, and you're still, worst case scenario, going to be looking at around about 20% return. Okay. Now I did have a question earlier in the week, David, does it make any difference whether I use the 3 ATR as a hard stop or a soft stop? Now the rule that I apply to it is once price closes below the trailing 3 ATR, you must exit. So it's going to close below the 3 ATR on a Friday afternoon after 4 o'clock. So Monday morning when the market opens, you go to the market, you sell your stock. The other way of doing it is to simply place a hard stop where your 3 ATR line is, and when price comes down and triggers that, then more than likely you'll be taken out at that particular level. There's pros and cons to hards and soft stops, and I think most of you are aware of that, and you need to choose whether you like a hard stop or soft stop. In terms of the overall performance, using a trailing stop with a hard stop compared to using a trailing stop with a rule that says I'm going to get out if price closes below it as opposed to hitting it, there's not a massive difference in the overall results. Using a soft stop on the 3 ATR does yield slightly better results, but for those of you who are uncomfortable using soft stops, then certainly you could use a hard stop if you wanted to. So that's the price volume volatility signal. Another example here, TNE. Again, a nice move initially, trading just purely on a breakout type of strategy, getting into a trade, hanging on for the longer term. Nearly gets stopped out down here, but again the rule is if it closes below, this would be an example of where if you used a hard stop, you probably would have been triggered out on that one there. Once you're in the trade, you get a couple of signals through this particular level, and in the space of 140 days, so what's that, about 4 months thereabouts, you're up 28%. It's not a bad rate of return if you said to yourself, you know what, I'm just going to sell a portion because I'm not too sure what's going to happen. Are there any other opportunities along the way that we could look to get back in and potentially trade this stock? Absolutely, there's a nice opportunity through here where we could, keeping in mind that we've already got the other half in the trade, and all we have to do at the end of the week, where's the line? There it is. Price is well above it. You'll see here the price came down, just about touched our green line, our trailing stop. If you had a hard stop there, I think you may well have been stopped out on that one. But we've had a number of price volume volatility signals go off along the way. And I think again, from a self-satisfaction point of view along the way, is there any thing wrong with taking profit? Absolutely not when you see those signals, as long as it's significant enough. Okay, so as long as it's a multiple of your initial risk, then certainly taking a little bit of profit along the way doesn't hurt. This stock eventually closed below the 3 ATR at around about $3, and that was over that period of time. That was over 726 days, so that's over 2 years, and you made 113% or 47% per annum. Now, I think if you went out there and asked people on the street, did they have TNE in their portfolio, or did they have G8 Education or MTU, they wouldn't know what you're talking about. And that's the value of the scans that you've got, that it's looking for those good sorts of stocks with great relative strength. Last aspect, price action. Really important, and it's going to be a huge focus on the results that I present on Monday mornings for the weekly analysis sessions, is that given that we're taking the emphasis off round numbers, the logical suggestion is, David, well, surely that means that we're going to have so many more trade setups, and potentially it is. Okay, so what that means is that in your trade selection, we want to be as tight and as specific as possible. So we only want those stocks that have the absolute best price action. Okay, so I want to go through now and just define good price action. So here we've got a stock, and as we can see, we've got higher troughs and we've got higher peaks. A medium-term peak there, the highest point between a short-term uptrend and a short-term downtrend. Now, as price moves up, remember we can only see the last candle that's formed. Now, between this last medium-term peak and the low here, we've got a candle in between which has a lower high and a lower low. So we're in a short-term downtrend. We get another candle at this particular point, which has a higher high, but it has an equal low. What happens subsequently the following day is that we get a new candle formed, and the new candle has a higher high and a higher low. So this candle means that we have now changed trend direction from short-term downtrend to short-term uptrend. So we've got a confirming candle, and that candle confirms the formation of a new trough, which is what we're looking for. So now that we've got a new trough, whereabouts did it form? Did it form at or above the second from last medium-term peak? There's the last peak, there's the second last peak. So as you can see clearly, there's the level of our medium-term peak, the new trough that has formed, and we know that trough has now formed because we have our confirming candle. That's pretty much at around the same level as our medium-term peak. Okay, so that's what we would refer to as good price action. Okay, good price action. Well, David, that's good price action. What does great price action look like? Glad you asked. Similar sort of setup here, in that we've got nice higher troughs throughout and higher peaks. Along the way, what we see is after our last peak, we see a short-term downtrend, and then finally we get a candle that has a slightly higher low and obviously clearly a higher high. So we move from a short-term downtrend to a short-term uptrend. Remember, the lowest point between a short-term downtrend and a short-term uptrend is a medium-term trough. There's our first medium-term peak. We've just had the formation of a confirming candle, and that confirming candle now confirms the formation of the new trough. Where is this trough in comparison to the second from last peak? Trough, second from last peak, it's way above the second from last peak. How did this occur? What was it in the market that dictated that the trough was going to form all the way up here rather than back at the old medium-term peak level? Something in the market, there's winds of change with this stock. The market can't wait any longer to be purchasing and bidding this stock up. There must be something in the background that is pretty good about this stock. Okay, clearly the new point of demand is not at the old medium-term peak, it's well above. Remember, old peaks once broken tend to act as future points of demand into the future. Well, the market was so impatient it couldn't wait for the price to come back down before entering in, adding to the demand side and prices moving up. So that's an indication of very strong price action, and that's what we're going to be looking for in our setups on a weekly basis. So only the strongest of setups. This is an example of weaker price action. Okay, now what we're seeing here is we've still got higher troughs, which is important because it shows that demand is in the markets, in the system, and it's creeping in at higher levels. What we're looking for though is where this demand is coming in, it should be at or above the second from last peak. So there's the medium-term peak that we're thinking about. We've got a confirming candle here that is confirming that we've had the formation of a higher trough. That's now the trough here. Where is this trough in comparison to the second from last peak? Last peak, second from last peak, it's well below. So this is much weaker price action, and in terms of what we're looking for our trade entries, we only want the best. Okay, so when we're doing our scans, we're going to be looking for strong price action or very strong price action. Okay, so when you're doing your scans, that's what I want you to be looking for, and if you've got any suggestions, I'd really like to see them, but please make sure that that last trough that you're looking at is well above or at least equal to the second from last peak. Okay, alright, so just moving forward, I just wanted to do a little bit of recapping of what we've gone through today. Alright, just a reminder, in terms of your initial trade setups, really no change. Okay, we know that we have to use protective stops. We know that they must be at least 2 ATRs below our entry level. and they must also be below the most recent trough. So typically the figure that we've used is 0.5% below the most recent trough. So no change there. We introduced the trailing of stops from a trade management point of view. So what we are doing is we are going to exit once the trade closes below the 3 ATR. Okay, now we're going to know that at the end of the week. We don't move our 3 ATR stop, we don't trail our protective stop, because remember, when we first get into our trade, our protective stop is set at 2 ATRs and below the most recent trough. It's going to stay there until the 3 ATR moves its way up and passes our initial stop. And from there on in, all you have to do is follow the green line, and then when price eventually closes below it, which it will at some stage, then that's your signal to exit. Okay, along the way, obviously, if you get any signals, for example your price volume volatility, and you've made a handsome profit along the way, then there's nothing the matter with putting some of those profits in the bank, but certainly no need to exit the full position. Stay in, trail your stop, and if you see another opportunity to get back in, then that money that you've profited from, certainly you can add to that position. Price action, alright, when we're looking for our setups, only good or strong will do. Okay, so no change there. Price volume volatility, the old rule for the price volume volatility, and this was really difficult to do. You had to split your trade in two. You had to trail the stop on half of your position up to 0.5% below the candle on which the signal went off, and then you trailed the rest of it as you would normally. We've made a small change. If you're well up on your trade and you want to take some profits when that signal goes off, that's fine. No problems with that. You don't need to close the entire position. I'd encourage you to retain at least half your position, trail the remainder, so that we get at least the opportunity to get some of those longer term trades that really add to the growth of your portfolio. So that's a small change. Round numbers, again, use at your own discretion. I'm not going to place any significance on them in terms of entry rules and in terms of exiting or anything like that. I'm keeping it very, very simple, and the reason I'm keeping it simple is because there's going to be a huge emphasis on that price action. That price action is the most concurrent indicator you can have. The other aspect, and there's no change here whatsoever, is your long-term peaks and long-term troughs are still significant. They are extremely important and must always be respected. So please make sure prior to entering a trade that you've got certainly a clear distance up to the next long-term peak or long-term trough, and you're only going to know that through scrolling back across the history of the stock that you're looking to trade or invest in. Okay, remember the rules that as you're coming up to a long-term peak, we always want to see a first test. Some stocks will plow straight through a long-term peak, but we want to just be cautious and make sure that all that old supply has actually been removed. Okay, so I hope that makes sense. I'll try not to change anything too much, unless it was going to add obviously some benefit in terms of simplicity and potential reward for your investing along the way. So summary for today before I launch into a couple of survey questions. I did them last week, so this week I'm going to try and have the survey responses on the screen so you can see them all. I neglected to do that last week. So quick summary, round numbers, use at your own discretion. They won't be given any notice. If you like, we won't be paying any attention to them in terms of trade setups or trade exits. Long-term peaks and long-term troughs, again, major points of supply, so please keep an eye out for those, as you always do, I know. Price volume volatility, it's a partial profit opportunity. Okay, the signal itself has always been that. It's not a rule that's that I've just created in the initial putting together of that particular signal, it was always the intent that it provided an opportunity, if you like, a bit of a flashing light, that when it goes off, to look to at least take partial profits. Price action, again, make sure that you've got either good or very strong price action for any of your trades. So that's the summary today. I'm going to now I'm going to find my poll question. Okay, so I'm going to launch, I'm going to select a poll, and let's launch that. So you should have a poll question on your screen at the moment that you should be able to answer the questions. So there's a poll in progress. There we go. So far you can see that 17% have 33%, 40% have voted, and interesting to see the results coming in. Not too sure whether I should show you that right now, whether that's going to influence your decisions. I'll take it off the screen until the voting is completed. I don't want to impact your views too much. Okay, we're up to about 67% voted. 72%. It's quite interesting, the results that are coming through. Not too sure whether we're going to get to 100. I'll show you the results anyway. At this point, it looks like relative strength comparison is a topic that you'd like covered, so I'll certainly be considering that this week. Certainly position sizing, talking with my colleagues before the webinar today, a suggestion, a question. What is it that clients continually have trouble with, and one of those was position sizing. So we'll go away and we'll have a think about that particular one. And what we'll present next week, but look, we might be able to put both of those in the next one. So I'm going to close off that poll, and I'm going to add another one. So there you go, another question for you. Are you actively trading at the moment? Be good to get a little bit of feedback on that. That's okay. So most of us at the moment are actively trading. That's great. Hopefully over the course of this year so far you've made some money and got some decent profits in your account. Again, if you're finding those relatively strong stocks, that will certainly help. I think those of you who are also on Jeff's Elite Investors Club, certainly I do use a little bit of fundamental analysis in my technical aspects. I'm pretty fortunate to have Jeff sitting at the desk opposite me that I can ask his view about some particular stocks, but even on a technical base, one stock in particular, VTG, is one that Jeff's members of up today over 100%, getting in at around about the 70 odd cent level. I certainly haven't made 100% on it, but about half of that, and that's been in the space of about 3 months. So again, that was purely, I got interested because of price action, using a 3 ATR, and a nice little trade to have in the portfolio. Next question, I'll close that one off, and the last one. Be interested to see how we go with this one. When was the last time you booked a coaching call? Now, some of you I know we've spoken to. In the last few days, etc. A couple there never. Well, you know what? Every communication that we send out now has the book the coaching call, and it's there to encourage you to just click on the link. You don't have to phone us, we'll phone you, and we can absolutely, if you've got any questions, etc., you'd just like to have a bit of a chat, talk about the markets, talk about price action, the things that you should be doing, or if there's anything that you need a hand with, that's what we're there for. So interesting, we're sort of different ends of the spectrum there. There's a number of you, being contacted just reasonably recently, but there's a few of you that have never booked a coaching call. So please, we're extending out to you to click on the link. That's all you have to do. We've got a team of guys here whose sole task is to help you all learn how to trade and invest to make it as easy as possible, so you've got the best chance of rewards. So don't be a stranger. Click on the link, and from that point of view, we'll be able to give you a call at your convenience whenever it suits, and help you out along the way. So I'll take that off the screen now. So just a couple of comments through here. That was the last thing that I just wanted to show before we wrap up. Now, with a bit of luck, my Beyond Charts screen here. This is the last week's US scan on the loose profile. Now, it went through the universe that I'm using is the Saxo list of CFDs. So in the watch list down here, the list that I asked it to scan was this list here, the Saxo Capital Markets US Share CFD. So that's just a universe of stocks that I can trade on Saxo. So I went through all of those, and in the standard ETC loose scan, it found 529. So when I went home from work on Friday and opened up the computer on Saturday morning after the market had closed, and thought, wow, this is great. I've got to go through 529 stocks looking for the right sort of price action, etc. For the audience on Monday morning. So I was rather pleased, you can imagine. Since then, what we've been able to do is actually put together exactly the same scan, so it's looking for exactly the same thing. But remember, with a loose scan is looking for stocks that are outperforming the market in 3 time frames, short, medium and longer term. But it's also, the loose scan is looking for those stocks that have just paused a little bit, so basically going through a bit of a retracement. So given that they've gone through a bit of a retracement, I'm looking for stocks that have had their retracement and at the same time just starting to turn around and move up. And that's what this USA loose scan, so exactly the same scan, but it's got another parameter that it's looking for some bullish candles on the end, i.e. that more than likely a trough has formed. And so by doing that, what it's actually done is it's cut down the list from 529 down to 115, which is a significant change. And it just means there that all I need to do now is, upon opening up a chart of the particular outcomes, same sort of thing. If I go up to my favorites and put on my swing chart, and I can zoom in a little bit, all I'm doing is looking for price action. Okay, so trough compared to second from last peak, oh, it's well below, pass. Next one. Trough compared to second from last peak, it's way down there, terrible. Next one. Trough compared to second from last peak, well, it's well above it, but it's already moved. Next one. Oh, trough at or above second from last peak. Hang on, that's looking promising. Maybe what if I put on my horizontal line here? Okay, there's my previous peak. There's my new trough. At or above, well, that's pretty good price action. Okay, it's not excellent, but it's good. The confirming candle here has formed, meaning that makes this candle the lowest point in a short-term downtrend, so therefore we have a trough confirmed. We've got a previous medium-term peak. Maybe that's worth experimenting. All I'd need to do now is go back out over a period of time. Where am I? I'm in all-time highs. That's not a bad thing. But guess what? Under the old system, we're next to 100. Oh, I can't trade that. Well, I'm not going to worry about 100. I'm more worried about the fact that we've got good price action. Great relative strength. You know what's happened on the US markets of recent. They've really sort of gone sideways, but over the last month, this stock has continued to put in a number of successive white candles and is about to break out again. So that's certainly one that I'd have a look on my list. I don't have to go through 529. I'm just going through the list. Price action's terrible. 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 Look at the trough. Is that at or above second from last peak? No. Pass. Oh, That one's a little bit more interesting. Let's have a look. Okay, that's not too bad. To me, that's good price action. Trough at or above second from last peak. Alright, all I need to do is zoom out and see where I am. Okay, not too bad. I write that down on the short list. Price action, terrible. Next one, it's already moved. Can't do anything about it, terrible. Where are we? Where's that trough compared to the second from last peak? It's not too bad. A bit of sideways movement through here. Yeah, it's not the best. I want the absolute best. Terrible price action. Terrible. Okay, I'm whizzing through this. Terrible. All I'm doing is using price action. I'm getting a bit interested about this one. Let's have a look. Trough at or above. We've got a confirming candle. I'm near $43. All I need to do is zoom out. Where am I? Guys, you can do this. It's not that hard. Alright. That's enough for me. I can see I've just gone through an hour, so I'm keen to get this this published and put up onto the website for everybody else. Don't forget, please, just click on the link as soon as we send you any notification. Click on the coaching call. Either myself, Jeff Cornwall, or David C will give you a call. We'll take as much time as you need. I think that's it from me. Thank you for watching, and let's talk very, very soon, and we'll catch up with you. I will send out a recording of the macroeconomic session that I do with Jeff on Friday. That should be posted out sometime mid-afternoon on Friday, and shortly after that you'll also receive the invitation to the weekly analysis session for the following Monday morning. All the best on the markets between now and then, and we'll catch up with you soon. Thanks for watching.